Hello everyone, I'm Shekhar from Momentum Lab. Today is 11th of August 2024 and it is day 132 of my Momentum investment journey, building it in public. And in this video review, I'll be covering three parts. One, my portfolio, and also looking at the stocks and markets in general. And lastly, I'll also cover the market snapshot. If you remember in the last weekly review, I presented a Google Sheet dashboard, which gives you a high-level sneak peek of how the markets are doing, how are the different sectors doing, and how are the different stocks within the Nifty 750 universe are doing. So we'll try to discuss more on that and see what we can get. It will be helpful for both discretionary as well as rules-based investors or traders. So firstly, let's look at the portfolio. We are right now at 7.7% overall up in the last 132 days, whereas the Nifty 200 index is up by 11.1%. So we are down minus 3.37 or 337 basis points with respect to the index. So the alpha is in negative territory. And we have been in the negative territory of alpha since 18th of July. It's almost close to 3 weeks. So we'll have to see how this week's pans out. And hopeful that maybe in near future, again, we'll be overpowering the index. So if you see the NAV, the blue color line is the portfolio's NAV versus the red color line, which is Nifty 200 NAV. We have been under the red color line since last 3 weeks, and we did try to come up and close the gap with the index. Initially, the gap was pretty high, around 7.7 percentage or 770 basis points difference was there between Nifty 200 and my portfolio. Now, slowly we're trying to cover up, and even the drawdowns are also reducing. The max drawdown that we had so far was around 12.75% during the election results a day, and even the recent week also was pretty bad, where we almost touched 12.5% drawdown from the highs. That's been the NAV. And if you look at the portfolio, as the momentum strategy suggests that we go long when the market favors us and we see that the stocks are doing really good and we want to invest more and more. And if the stocks are losing our momentum, we want to step out of the momentum. Now, this is the theory. Now, this theory needs to be translated into a mathematical format. And that's how this strategy is also constructed, so that as and when the market is moving and our portfolio is moving up, we keep on adding, or the portfolio automatically takes into overweight equities. And as the market starts to fall, the portfolio starts to come down, automatically we move more into cash position and we become underweight the equities. So that's how it is being translated, the strategy. And we'll have to see if the strategy performs the index in the longer run. That is the Nifty 200. Nifty 200 is the universe from which I pick the stocks. Now let's look at the XIR also. The XIR is at 22.09% right now, more saner levels compared to the previous levels. As time progresses by, we'll be seeing this number stabilize around a particular figure. That's the figure that we'll need to keep a look at. So any exits that I make, all will be recorded here in this sheet. So you can always take a look like which stock I'm exiting and which stock I'm entering. And I also mentioned the reasons why I exit a stock, whether it is because of a stop loss being hit or whether it is because the worst rank held being breached. Now I've changed or relaxed my worst rank held criteria. Initially, it was very tight. Like if the stock comes below the top 30 rank, I used to exit. Now I've moved it to 40 and then to top 45. So as we relax the worst rank held, then the probability or chance of a stock exiting because of worst rank held diminishes, and more or less the stock will exit only if the stop loss criterion hits. So that's what we've been seeing in the last 4 exits. It is mostly because of the stop loss hit. And overall, in the last 132 days, I've made 29 different exits. And some of these stocks I've exited multiple times because I've purchased and I've exited, etc. Out of these 29 different exits, majority of them, or 75% of these exits, were because of the worst cycle, and 25% of them are because of the stop loss being breached. Now, if you look at these stocks, the current composition is 11. Out of 15 stocks that I usually held, 4 stocks I've exited. There are only 11 stocks that I'm holding right now. And I'll be adding the 4 more stocks or rebalancing during the 15th of this month. And we'll see what new stocks will come up and which stocks we'll have to add, which stocks we may have to exit. We were pretty close to exiting RBNL because it came almost to 20%, but it again came back. Now it is at minus 19.88%. So far, nothing to worry, all good. And the worst case loss is at minus 82K, which is like if everything goes downhill and if all the stocks get exited because of the stop loss being hit. The stop loss I calculated as the 20% from the 52-week high. If any stock falls below from its 52-week high by 20%, then I exit, irrespective of my entry point. And the portfolio heat is at 210.9%. Basically, it means that the profits divided by the worst case loss. If the profits are more than the worst case loss, then this number is more than 100%. The bigger the number, the higher is the buffer or safety for us that we're going to make some money from the strategy. So that is it about the portfolio. Let's now take a look at a couple of other things that are happening in the market. But before that, I wanted to show you guys one main change that has happened because of the budget season. In the recent budget, the taxes have been hiked, both the long-term as well as the short-term capital gains. The short-term capital gains are now at 20%, whereas the long-term capital gains are at 2.5%. Now, if you take into consideration the cess and charges, then effectively the long-term capital gains comes to 13%, whereas the short-term capital gains comes close to 21%. So that's the taxation rules right now. Now, this definitely has an impact on DIY investors or mutual fund investors or PMS or small case or any type of investors. Now, this new rules are created in such a way to change a behavior of investors, or any rules or any legislation are meant to bring some behavioral change, whether it be the investors or citizens or whoever be the subjects. Now, what we understand or what I understand from this tax rate hike is that the government wants to ensure that the equity participation is happening from the professionals' hands. And hence, you see that there's an advantage for an investor who is investing through mutual fund. I'll talk about the different advantages that a mutual fund investor has over a small case or a portfolio management services firm or a DIY investor. Now, there are a couple of advantages that a mutual fund has. The first advantage is that there is tax efficiency. Now, whenever a mutual fund churns out their portfolio, like they exit a stock or they purchase a new stock, right? Then the taxes need not be paid by the investor on all these portfolio changes. The taxes are paid only when the investor exits or redeems their units from the mutual funds. Now, depending on the time duration, whether if it is less than 2 years or more than 2 years, based on that, they are either charged LTCG or STCG. Now, whereas if you are a DIY investor or a small case investor or a PMS investor, if you're churning your portfolio, let's say less than a year or more than a year, now based on the duration, you are charged either 13% LTCG or 21% STCG. Now, this over a period of time compounds or accumulates and will cause a difference between your strategy versus a mutual fund strategy. Assuming that you and mutual fund are doing the same strategy of churning out stocks or buying, or if both of you guys have the same kind of rules, then you are DIY investors are at disadvantage compared to the mutual fund investors. One, because of the taxation, and the mutual funds are not taxed whenever they churn out the portfolio. That is one. Second thing is that the dividends, whatever dividends that you accrue based on your investments, if you are a DIY investor or a small case or a PMS investor, then all the dividends are charged at the hands of the investor, based on your tax slab. Whether you fall under 30% or 20-25%, whatever tax slab that you fall under, likely that amount is deducted. Whereas if you are investing through a mutual fund vehicle, then all these dividends are not taxed, and because they're all invested again in the growth. If it is a growth option, then these are not taxed, and that small amounts of dividends also keep on adding and accumulating and keep compounding and adding more to your returns. So these are the two major advantages that mutual funds have over DIY investors. Now, Capitalmind, which runs a lot of small cases and PMSs, they have done a beautiful article on what is the impact that these new taxation rules have on the DIY investors versus the mutual funds. So, for example, if you are a DIY investor or a small case investor or a PMS investor, and this is pre-budget, if let's say this is the returns that you are supposed to make to break even or to compensate the equal returns that a mutual fund is doing. Earlier, if a mutual fund delivered 12% returns, then if you had done 13.5% or 13.4% as a DIY investor, then you would have made same kind of returns. This is pre-tax. So if a mutual fund gave 12% returns, and if you had done 13.5% returns pre-tax, then both of you guys end up making the same amount of money, because the taxation rules are higher to the DIY investor. Now, post-budget, that is this column, you see that what is the new pre-tax returns that you need to make to basically break even along with the mutual fund. Now, based on the different returns that you get with the mutual fund, you also see what is the delta that you need to get over and above the mutual fund to just break even with respect to the mutual fund. So if mutual fund gives you 12% returns, then as a DIY investor, you need to make 14% returns. If a mutual fund gives 19% returns, then you need to do 22.5% returns. So anywhere between 2 to 3.5% returns over and above a mutual fund, DIY investors need to make. So the bar has been stepped up now. So for DIY investors or for small scale investors. Now we'll have to take this into consideration while coming up with our own strategies and keep a track of it. That's why I say it is important that we see how is our performance doing vis-a-vis the index or any benchmark. So we'll know whether we are in the right direction or not in the right direction. So if as a rational investor, let's say we feel that or we see that the data doesn't say that we are able to beat benchmark, then there is no point chasing a strategy which doesn't beat the benchmark. Even if it beats the benchmark also, again, there is no point if you're unable to have at least 3 to 4% alpha over and above mutual fund. Only if you do, then it makes sense to be a DIY investor and continue our investing process. So there are small changes that we can bring up in our own strategies instead of having a high churn strategies, which are at a massive disadvantage because of the STCG. We can have a longer term strategies, maybe a couple of things that I've already tried to implement. Maybe I have to implement even more. I'll be talking about them in the next video when I do rebalance, that having a longer frequency or longer cadence of rebalance than a shorter rebalance of, let's say, weekly or bi-weekly, and moving it to monthly or quarterly rebalance. That is one aspect. And loosening up a bit on the worst rank health is one way, so that we do not have high churn. So that's the reason I moved from 30 to 40 to 40 to 45 worst rank health. And there are other aspects also of how we can construct our own strategy. Maybe instead of looking at very short term to medium term signals, maybe we can look at medium term to long term signals. So that's another way where we can construct our strategies which can endure for a longer period of times without having to churn a lot of strategies. Now, if your strategy, even though if it is high churn, but if it performs way above than the benchmark indices or the mutual funds, like northwards of 8 to 10%, let's say above the mutual fund, then still fine. You can be safely covered and be doing your DIY strategy. But if you are neck and neck with the mutual fund, like what I'm seeing right now with my portfolio, I think it is 130 days is too short period of time to evaluate. I'll be waiting for at least a year or so, even furthermore, year to 2 years or so, and then taking a call, because there's still some small modifications that I think I can make in the optimization to ensure that this strategy has less churn and has a longer term signals that we can create. I'll be talking about these signals also, how you can be generated better and how can we ensure that the churn is also eliminated in a momentum portfolio. I'll be covering in the next session. So that's about the portfolio, and this link also I'll be sharing. You can take a look at it. It's a pretty good blog on what is the impact of budget on different investment styles. Now let's look at the market once and see what is happening with the market. So far, even though the markets were showing a lot of volatility, but if I look at the bigger picture, it doesn't seem to be worrying. Let's take a monthly picture and then zoom down from monthly to weekly and then finally to daily level. So this is the Nifty 50 chart. Nifty 50, as you can see, we are right now here. It looks like a proper bull trend. There's no need to worry if you are looking at this trend. The same is the case with Nifty Junior, Micro Cap, or Mid Cap, Small Cap. Proper uptrend. There's no signs of sideways or correction mode if you look at monthly. But if you look at weekly, we see that there is some bit of supply on the top, as you can see this wick, and then there's also a bit of demand at the bottom. So this basically means that there is a small range or a range in which we find that the market is trading. Now, this is not just with small cap. You can also see that across the indices, like Nifty Mid Cap, you see a upward wick and a downward wick. So the ranges have been formed. This is the Nifty, same with Micro Cap, and this is Nifty Junior. So you see that this range, let's plot this range, the top and the bottoms, and then zoom down to Nifty Junior 50. Let's look at the daily time frame. You see that in the daily time frame, yes, now we are seeing that there is a sideways. If you take a big picture of monthly level, it seems fine. On a weekly level, we see that there is a slight supply overhead and demand overhead at the bottom. So this is basically means that it is in a range bound market. And when we see it daily, it becomes even more clear that it is in fact in a sideways format. And sideways markets are the enemies of momentum investing, because if it is going up, you make money. If it is going down, you exit and you stay in cash. But if it is moving sideways, that's when it causes a lot of churn. Some stocks go up, some stocks go down, and you jump between one stock to the other if the signals are too small or too quick. If the signals are pretty decent and long enough, then you might not jump so quickly. And by the process of jumping between the stocks, you unnecessarily end up paying the taxes, and you're also incurring some cess and charges, STTs, brokerage, which again eats up your alpha and returns. So this is the daily chart. You see that the markets are taking a rest at the 50-day EMA, and right now it is just sitting just above the 21-day EMA, not just the Nifty Junior, but also if you see the micro cap, it's at just above the 21-day EMA. Nifty is also very close to 21-day EMA. Mid cap is also 21-day EMA. Small cap is also 21-day EMA. So all the markets are range bound and they are sitting at the key moving averages, meaning they have the equal propensity to go in either directions, either upward or downward, and stay in this range. You'll have to be pretty cautious and see how this goes out, and definitely not a good market for traders. So this is the markets, not a great time. Now let's look at the stocks once. Now, before I look at the stocks, I would like to show the RRG plot and then see the stocks which are worth taking a look at. So I've plugged in all the stocks that I hold in my portfolio and I've run the RRG plot. So right now, all the stocks which are in my portfolio are in the leading quadrant, and there's one stock which is in the weakening quadrant, that is RBNL. Two stocks come up very strongly. One is Trent, second is oil. Trent is perfectly poised, and it is showing, it is moving towards the northeast direction in the RRG plot. Like I mentioned in my previous RRG plot video, that stocks which are in the northeast direction or moving towards this direction are the stocks which are having very great momentum as well as relative strength. And the stocks which have a bigger tail length, meaning they have even more power behind their move. And the second stock is oil. Oil has been in the leading quadrant and it is making circles within this quadrant and with a very big wicks. So three stocks are coming up pretty quick, pretty good. One is Trent, oil, and RVNL is has now moved on to weakening quadrant. So let's look at these three stocks. This is Trent on a daily chart, pretty good. It is broken out, and this is on the weekly chart. That's what we see even in the RRG plot, that is properly in uptrend with good volumes, respecting the key moving averages. Then we have oil. Oil also has been in an uptrend, and it has made a small BCP kind of a pattern or a small basin. Is a weekly chart, and ready to go up. These two are pretty good stocks in the current portfolio that I have. And RBNL is now weakening up a bit. I think it is pretty common. If looking at its chart structure in the earlier chart structures also, once RBNL makes a good move, it rests for a couple of weeks or months and then again makes an up move. That's the same pattern it has been following, and even now, I think after the up move, it has now been consolidating in a orderly fashion. So we'll have to see how this goes. If it goes even further deep, then we might have to exit based on our exit rules of 20%. I think we have come even close to the 20% rule lastly in this previous week. Let's see if this goes further, then we may have to exit. If it takes an up move from here, then we'll continue to ride this stock. So that is about the stocks. Now let's go back to the market snapshot. So as you guys are aware, so this is the snapshot that I prepared. This is 10,000 feet level view to mean sea level kind of a view. It gives you a snapshot of how the different assets are performing over the last 1 year, 6 months, and 1 month. So we see that the NASDAQ has been a very bad performer over the last 1 month. It has lost by 9%, whereas the Nifty hasn't lost much. It has lost only by 0.5%. Gold is also not done good. It has lost 5% in the last 1 month. And liquid bees, this is the ASBL liquid bees, Aditya Birla, has done 0.5%. So we see that most of the equity indices have been, or in fact the commodities are not doing that great. Nifty is holding up. We'll have to see how it does going forward. And over the last 6 months, Nifty is clearly the winner. And even in the last 1 year, Nifty did really well. Now within Nifty, if you see or within the Indian equities, if you see the different market caps, Nifty Next 50 or Nifty Junior has done really well over the last 1 year or 6 months. And over the last 1 month, all the indices have stayed flat. Nifty Junior did a little bit worse. It is down by 1.5%. That's about the different market caps. Now, if you see the sectors which did really well in the last 1 month is pharma. And you also see that consumption also did pretty well. And rest all, FMCG also did pretty well, 4.1%. I think this came out even in the last time when I showed the RRG plot that the defensives are now picking up steam. And we see that the metal reality, PSU banks, which were doing really well earlier, have now started to underperform. So that's about these sectors. And if you see 6 month and 1 year time frame, almost all sectors did really well except for IT and media. In fact, IT and media haven't done really well over the last 1 year also. IT did well over the last 1 year, but media is a poor performer over the last 1 year duration. And private banks also haven't done well over the last 1 year compared to the Nifty index or the benchmarks that we see. So that is it about the sectors. Now let's take a look at the stocks, individual stocks. Now, before I do that, I wanted to show what I have to present in this week. So last time I've shown you guys that we can calculate the past 1 year, past 6 months, and past 1 month returns of all the Nifty 750 stocks. You can see the stock name on the left on the column A, and you see the uh, and you can see the returns over last 1 year, 6 months, and 1 month in column F, G, and H, right? Now, this will give you a very good perspective of which stocks to pick, maybe for trading or for investing or for rules-based or discretionary, whatever the style of format that you want. This gives you a good starting point for you to pick up some of these stocks, this tool. Then I wanted to add even more depth to this and make it even more robust. So what I did was I tried to mimic or try to create a similar kind of a format or a structure as what MarketSmith does. Now, MarketSmith is a pretty great tool that helps you identify stocks which are in strength, also helps you identify the sectors which are in strength, and then they also do recommendations of stocks, portfolios, but also give you a good platform to play around and see apply different screeners and come up with the stocks that you want to invest. Now, one such metric that I really like from their platform is the price strength. Now, what they do is this price strength, in their own words, I just read it here. The MarketSmith relative strength rating shows you which stocks are the best price performers by measuring the stock's performance over the previous 12 months. That performance is then compared with the performance of all other publicly traded companies in India on a 1 to 99 scale, with 99 being the best. So what they do is they take a stock, they compare its performance over the last 1 year, and they measure it or they compare it against the benchmark, let's say Nifty 50. After doing this benchmark, then they compare all other stocks in the Nifty 750 and see which stock has outperformed the most over the last 1 month with respect to a benchmark, and then they give you a standardized ranking between 0 to 100, maybe like 1 to 99, between like a percentile ranking, so that it becomes very easy for someone to find where are the strong stocks, and you can invest in those strong stocks or trade based on those strong relative strength stocks. You can take the help of charts or any other metrics and come up with your own criteria. So they also suggest that MarketSmith suggests focusing your efforts on stocks with an RS rating of 80 or more. So that's what is their recommendation in terms of picking great stocks. They also have a couple of other ratings also. I'll be not going into those at this point of time. Maybe at some point I'll also cover group rank, but right now I'm just showing you how to calculate the price strength. I'm going to give you an example of 361, which is nothing but IFL Wealth erstwhile. So they've given a ranking of 83. Now let's look at their strategy or their calculations and see how we can replicate the same rating. So what they take is they have taken last 1 year. So let's hide these columns, and they've taken last 1 year. And what they do is I'll hide these two columns and also hide this. Yes. So first they'll calculate the absolute 1 year returns of all the stocks. And then they'll calculate the relative returns, meaning they'll subtract the Nifty 50s returns for the last 1 year. So I've done the same thing. So if you see, I've subtracted this 100% returns minus the 25%, which is F10, sell F10. So you get 75% roughly the returns of 361. This is 75% over and above the benchmark. Now, the same way, I've calculated the returns for all the Nifty 750 stocks. You can see here. And then what I did was I did a calculation of the rank for all the excess returns that are there for the last 1 year of all the Nifty 750 stocks. I calculated the rank, meaning, so the stock which has given the maximum outperformance will get a rank of 1. The stock which has given the least outperformance will get the rank of 750. As you can see, 361 has got a rank of 132, meaning there are 131 more stocks which have outperformed even more than 361. So that's the meaning of the rank 1 year. Now, what I'll do is I'll then convert this into a percentile score, meaning now we have 750 stocks, right? Now, between 750 stocks, I get a rank of 132. Now, if I have to standardize this between 0 to 100 and get a percentile, then I have to convert this. Now, so what I've done is I've converted this into a percentile. This is the formula that I've applied. You can, I'll share this sheet. You can always take this sheet and make a copy of it and see all the formulas. So this formula basically converts this rank into a percentile. Now, you see that when we convert this rank into a percentile, it comes to 83. So that's the same percentile as what we see in the MarketSmith rating. Now, it is pretty straightforward. They've used only 1 year excess returns to calculate the percentile. Now, the other step you can do is, I've filtered the stocks which are above 90 percentile, and you can list down all the stocks which are above 90 rank, and maybe this becomes your shortlist of stocks to play around or to construct whatever strategies, portfolios that you want to go ahead. Or even if you look at as a non-discretionary rules-based momentum investor, since it is Nifty 750, more or less, whatever be the strategy or universe or the number of stocks that you hold, it is pretty certain that, I mean, at least high probability that your stocks might be from this list of stocks. The top 10 percentile of Nifty 750 is nothing but 75 stocks. So more or less, your momentum portfolios will be having these 75 stocks in some way or the other. Either they might be in your portfolio or they might be in your top ranks. Maybe you're not holding it right now, in some format or the other. This is the top 75 stocks based on last 1 year returns among the Nifty 750. You can complicate it even more further. When I say complicate, not necessarily in a bad sense, but you can add more complexity in terms of making it more robust. Instead of taking only 1 year or longer term returns, you can also add 6-month medium term returns. You can also add 1 month short term returns. And then same way, you can calculate the excess returns over 1 year, 6 months, 1 month. I've done this for you guys so that this formula is readily available. And then again, you can calculate over the last 1 year, 6 month, 1 month, the ranks of these stocks. And then you can calculate the average rank. Let's say in the average, I have taken only column L, meaning 1 year. Let's say if you want to take an incubated 1 year, 6 month, and 1 month, then what you do is L23 to N23. So you get a average rank like this, and then you can drag this completely. So you get the final score, which is based on the average rank of last 1 month, 6 month, 1 year returns. So based on your preferences, you can tweak around. You can give different weightages to different time periods, or maybe you can choose entirely different time periods. Instead of 6 months, maybe you can choose 9 months, whatever format to do. And then ultimately you arrive at the final score. The final score is what matters. And within the final score, we are interested in seeing the top stocks or the stocks which are in the top 10 percentile, meaning from 90 to 100. This list of stocks will be useful, as I mentioned, in any of your further trading styles. So that is it about this week. We've covered the portfolio review. We've also looked at the markets and the stocks using the RRG and also the charts. And this will also have shown you how it can be helpful to create your own trading decisions.